Hi, I'm Brian McGough, and I head up the retail sector here at Hedgeye Risk Management. And I want to talk to you for a couple of minutes about Lululemon. This is a stock that we've been very bearish on over the past 6 months. And earlier today, we put out about a 52-page deck that outlines why we're no longer bearish and we're starting to turn bullish on the margin. Now, there's a couple of things. One, there is absolutely no question that key customer metrics are getting better. That was a major problem last year. Not as much of a problem anymore. So things are getting better there on the margin. That's what matters. And there are also some key challenges that still remain. There's a lot of self-inflicted wounds that they still have to fix, a lot of competition which is still coming on board, and they need to address that. But we won't ignore such big positive changes on the margin. Very difficult to stay bearish when we're seeing those kind of changes. So I want to start off here and flip to my favorite chart. And it talks about how customers view the brand, whether they'd recommend it to their friends or not. This might be a little tough to see there, but on the left-hand chart, there's a little blue bar way over to the right. That is Lululemon. Those are the percent of people 3 months ago that would recommend this brand to their friends. If you look at those readings right now, you're going to see it's radically different, and it's right in line with peers. Now, in line with peers isn't necessarily great, but it is when you have that kind of change on a sequential basis. Now, let's look at quality, because that's a big deal. Now, there's this pair of pants that they have. It's called Luon. It's that one where when you put them on and you did a down dog, it was basically completely see-through, and it was a big PR disaster. That's about 17% of their product. So they had to deal with that in the first and second and even third quarter of last year, and now they're starting to cycle that. But this isn't just about easy comps. This chart here asks people, is the product quality getting better or getting worse? Off to the far left, it's that red bar. Those are the people who say it's getting worse. There's probably a lot of bad blood, and they still just don't like the product. But off to the far right, that's where you have the brands, or I should say the customers, who say that the actual brand is getting far better in quality. And that outweighs those who say it is getting worse by a factor of about 2.3 to 1. And I really like that. Next, I'm going to look at a key stat I look at. Why are people buying less? Now, I'll slow down a little bit on this one because there's a lot of different factors here. And we ask people why you're buying less product than you were a year ago. Now, there are 2 columns on this for each brand. One is from a survey that we took a couple of months ago. The other is from our survey that we just finished yesterday. And you could see some pretty key differences. Now, there are 4 factors. 3 of them are bullish, 1 is bearish. That point number 1, poor reputation, big problem last year. Not as much of a problem now as it was even just 3 months ago. So check, boom, that's bullish. Poor quality. This is like their problems with the Luon product. It's getting better on the margin. Still not great, but it is absolutely getting better. Lastly, all the way to the far right, you got number 3. These are people who don't like corporate management. So rare for a brand to have a customer that does not like management. But here, we absolutely had that for a whole host of reasons. And that also has gotten better on the margin. It's not gone. And that's something that I think that they're going to have to deal with for a couple of years. But it is getting better. Unfortunately, there's a 4th point here, and that point is all the way to the far left. You see their price. And these are people who think that prices are too high. So they're shopping less because prices have got to come down. And that's a problem for a company who has a gross margin of about 53%, and the rest of the industry is in the 40s. So I don't think that that margin level is going to actually be able to be sustainable. Now, where is the business going? If they're not shopping at Lulu, it has to be going somewhere. So let's flip over to the next page. You have here again, this is the old survey and then our new survey. And you can see which changed on the margin. And I think it's neat. Some key conclusions. First, you know, about what, 5, 6 brands in from the left, you have Nike. I mean, Nike looks bulletproof. So it looked great in our last survey. Now it looks phenomenal. So right next to it, you have Under Armour. Looks really, really good. Looks less good now, but still a very, very big threat. If there are two brands on the planet I don't want to lose share to, it's Nike and Under Armour, because I'm telling you right now, they're not going to give it back. Now, point 3 over here, I would point to VS Pink. That would be a brand that I think a lot of people know more in the like teen and 20 space. It's also done a very good job as far as gaining share. The biggie, however, all the way to the left, actually 3 in from the left, is a brand called Athleta. A lot of people here might not know about that. It's owned by Gap. It's only about 2% of Gap sales. It's teeny for Gap, but it's actually quite big as a competitor to Lululemon. And it just has made huge inroads here, and that's something that I'm very worried about. So I'm going to bring it all together here, and I hope you can make out these charts on this next page, but it's going to show you my assumptions in blue and the street's expectations in red. I'd point you towards 2 of these 4 charts. In the upper left-hand corner, you've got revenue. So I am so far above where the street is in revenue, and it's over a 5-year time period. A lot of them don't have 5-year models, but I mean, that gap there is just completely obvious. Unfortunately, it's not as obvious as the gap on the lower left-hand side, and that shows where my operating margins are relative to the street. So the theme there is that I think they'll get a lot more revenue. I think it'll build up to a $3.7 billion company, but it's going to have operating margins going from 25 down to about 19, and that is problematic. I think for the time being, it's a lot better that it's got sales mo, very, very good. With the stock in the 40s, I think that'll work. If we're sitting here in the stocks in the 60s, it's going to be a very different story. This is a huge dynamic here. I think it's worth paying attention to. I certainly will be. The point with all of this is that 3 months ago, it was a survey. Everything was negative, unequivocally. That's why we shorted it. But now it's probably a 50-50 split, and we call that things are getting better on the margin, and that's very important. So I think that overall now the bear case is dead. I'm a little bullish. I want to get a lot more bullish, but I have to wait and see a lot more of these factors turn in my favor. I'm Brian McGough at Hedgeye Retail. That's how you can reach me on Twitter. I look forward to your comments. Thanks.